So in the fourth quarter, definitely the biggest story was passage of tax reform in the US. Now this was the first legislative victory for President Trump and the Republican Congress. So expectations coming into the quarter were quite low that something would get done. Now as momentum built, the growth-friendly aspects of this tax package began to get priced into equity markets, and equity markets performed quite well. So there's a cut in the corporate tax rate down to 21% from 35%, as well as other business-friendly measures that allow companies to write off capital expenses immediately, and that should really drive some performance for companies in the US. Now at the same time, bond markets didn't get too concerned about the inflationary aspects potentially of these plans, so bonds hung in there and didn't do too badly either in the quarter. So when it comes to equity markets in particular, we were positioned for strong equity markets throughout the year. However, the scale of market returns did exceed our expectations. Now, this was driven by the fact that you had the major engines of the world economy, the US, the Eurozone, China, Japan, all kind of converging and clicking at the same time, driving the global economy higher. This is the first time we've seen that in several years. That in turn led to stronger earnings growth for companies, which of course powered the equity markets higher. Starting with equity markets, that same story of broad global economic strength, I expect that to continue through 2018. That in turn should lead to stronger earnings from companies, which is enough to power equity markets higher from here. Equities by no means are cheap where we sit today, and there is actually a little bit room for them to get more expensive. So equities, we don't expect quite the same level of returns that we saw in the past year, but still positive returns out of equities. Flip the page looking at bond markets. Now, in 2017, bonds did reasonably well. Inflation was not too much of a concern. That kept yields in check. This year, the one upset that could hit the bond markets is if inflation begins to heat up at a quicker pace than what's expected. Then central banks will need to tighten policy more quickly, and that, of course, could lead to some volatility and poorer returns in bond markets. Now, there's certainly the possibility that Canada could participate in the stronger global economy in the year to come. However, the list of risks facing Canada is quite long. Whether it's the over-indebted consumer that's facing an uncertain picture on interest rates, or an inflated housing market now that has multiple measures coming out from various levels of government trying to cool off that market, or the NAFTA negotiations, and there's the possibility of a disorderly breakdown in the NAFTA picture as well. As you begin to sum up these various risks to the Canadian economy, it certainly makes sense to exercise some caution when it comes to Canada.